my estate into the hands of younger generations in a way that they may not control either, right? Because I can control at the time I create the trust who the trustee of that defective trust is. So usually my children are going to be beneficiaries of that trust. As I mentioned, it's defective in the sense that I pay the income on those trust assets, which, by the way, allows me to make additional tax-free gifts, at least estate and gift tax-free gifts, to my children. Right? Because let's say that trust now generates income, taxable income, and I'm paying the income tax on that income that's generated, not the trust. And so the trust is not losing any more value by the payment of tax on the income it's generating, because I'm paying the tax. So in essence, that allows me to make additional gift and estate tax free gifts to my children and grandchildren. As I mentioned, there's no capital gain on the sale because I'm essentially selling to myself and taking a note back. Now, the disadvantage of this technique, well, one of the problems I may have is if I sell the asset to that defective trust and the trust assets do not generate sufficient income to pay that note obligation, well, I've got a little bit of a problem now. So I've got to make sure there's going to be sufficient cash flow on the business to be able to pay the installment obligation on the note they've agreed to pay me. If I die and there's still a balance due on that note, well, that balance due on the note is still includable in my taxable estate for estate tax purposes. But as I said, if that business is appreciated in value after that transfer, none of that future appreciation is includable in my estate. And if the trust does not distribute all of its income to me in payment on the note, there may be an additional tax burden because the trust is also filing a tax return and paying income taxes on the trust income not distributed, and those trust rates are going to be a little bit higher than the individual rates. But we've got one going on right now, for example, a client that owns multiple car dealerships, that we are selling a significant, we're transferring the car dealerships to an LLC, and then selling the LLC interest to a defective trust. Allowing that client to shift significant wealth and future appreciation out of his estate to the benefit of children and grandchildren, and on an amount that's no longer going to be taxable to him, but allow him, in paying the income tax generated on the trust assets, to make the additional tax-free gifts to the kids and grandchildren, and making a huge reduction to the potential estate tax if those assets were left in his estate upon his death. So this is a quick overview of how that defective trust technique might work in the transition of the business to the younger generation. The parents create the trust, make an additional cash gift to the trust. Typically, that's got to be about 10% of the assets that ultimately are going to be sold to the trust. Parents then sell the business to the trust, take back a promissory note, and which, as I said, ensures a good cash flow to the parents over the term of that note as well. Future appreciation goes to the kids. So as we've covered, there are a number of techniques to transition the business while minimizing the estate and gift tax exposure that might otherwise apply. The family limited partnership, the S-corp recapitalization, sale to a defective trust. Now, what technique might make the most sense, or what other technique might make the most sense, depends on all the particular facts and circumstances, obviously, of the family involved, the business involved. All of those things have got to be taken a look at. But if you look at, no business plan, and particularly the chunk that the government is otherwise going to take without effective planning. When we get to the year 2013, as I mentioned, if Congress does nothing else, we're going to have $1 million estate tax exemption and a top estate tax rate of 55%. The biggest problem that closely held and family businesses run into is if, without planning, the value of that business is includable in your estate for tax purposes, and if an estate tax is otherwise due because of that, that tax has got to get paid within 9 months, typically. That leaves very little time to then try to transition the business or come up with the cash to otherwise pay that tax. You know, that's the headline you always hear when Congress is talking about whether to eliminate the estate tax or not, because the family farm gets lost, right? That's what happens. With a 9-month period to pay that tax, you otherwise might end up having to, or your heirs end up having to liquidate the business at a fire sale just to come up with the cash to pay the tax. And that's where you end up with no planning at all. You know, with planning, who knows? You might have significant savings and the ability to save the family business for the younger generation that you're trying to protect. Objective, forward, critical thinking, though, is necessary when looking at this planning. Advanced planning permits the balance of income. Perhaps if you have charitable ideas or charitable inclinations, that can always be incorporated into any of the kind of planning we've been talking about. Addressing family wealth issues. Remember, estate taxes are a confiscatory tax, but an elected tax. It's one that we oftentimes can greatly minimize and perhaps eliminate altogether with good forward-thinking planning. Well, thank you for coming. We appreciate your time, and I hope you learned something that was worthwhile as we went through the seminar. If you have any questions, we'd be happy to address those questions. I think we've still got plenty of treats here. Julie,